Morning. Welcome.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement, or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you one CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only one sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Manager.
Mike, it sounds like you might need to reintroduce us here. Pam's connection sounds like it's not quite working.
I was just about to say, good morning, everyone. My name is Mike Lumsden, and on the line we also have Tracy Paglia. Apologies, we might have had some connection issues earlier. We're pleased you can join us for our higher education series today. Today's topics will cover an array of updates, and there's a lot to cover here. So unfortunately, we might not have time to cover questions at the end, but we will be sure to get back to you separately if you do want to leave some questions throughout the presentation. Within the presentation, we're going to chat about first the 2020 deferred tax deadlines. Next, we're going to hit on some COVID-19 legislation aimed at assisting organizations with funding, and then how those then impact nonprofits and donors. Next, we'll discuss the IRC Section 512A6 proposed regulations, which for those of you who are unfamiliar with that terminology, this would be the regulations just released about 2 weeks ago with more specific guidance on the siloing or bucketing of separate unrelated trades or businesses as it pertains to the Form 990T. And then lastly, we will save a few minutes to chat about Dynamex, which is the California law aimed at curbing misclassification of employees versus independent service providers. And without further ado, we'll get into the real meat and potatoes of the presentation, starting off with the deferral of tax filings and payments. Now, in April, the IRS granted relief to all organizations in regards to the filing of tax returns, extensions, or any estimated tax payment due on or after April 1st. These dates have automatically been extended, meaning you don't have to do anything, to July 15th. Now, at first, we weren't sure if these automatic extensions would actually apply to 990s, but the IRS did later come out and clarify that 990 filings were covered. So typically the May 15th deadline for 630 year ends is extended until July 15th. If you did have any extension or estimated tax payments due on or after April 1st, late payment interest and penalties will not accrue until July 15th. One caveat here is that most but not all states have conformed to the federal due date deferral. So if you do have multiple state filings, do ensure that those states you file in have conformed. For those with California filings and just California filings, this is a state which has conformed, meaning those state filings are not due until July 15th. Moving on, next we wanted to highlight some COVID-19 specific legislation. Here, you're going to see a few items here. We have first, the CARES Act. There's been 4 rounds of legislations. We're really only going to highlight the CARES Act, which is that second act, as well as the Families First Act, which is the third slide, or the third bullet point right there. Now, from a high level, we wanted to highlight some of the differences between the Family First Act and CARES Act, and we'll get into the details of the Family First Act later on in the presentation. Before we did, we wanted to discuss some of the key provisions of the CARES Act and how it might impact your organization. First and foremost, we wanted to talk about the modifications to the net operating loss rules. Now remember, with the Tax Cuts and Jobs Act passed at the end of 2017, this changed how NOLs could be utilized. For NOLs incurred in 2018 and beyond, TCJA stated that these losses could not be carried back and could only be carried forward, and losses from those years would only be able to offset 80% of taxable income for the years carried forward. Well, the CARES Act temporarily suspends this rule. So for net operating losses arising in years beginning in 2018, 19, or 2020, taxpayers are allowed to carry back this loss for up to 5 years. Additionally, the 80% limitation is deferred until the taxpayer's first taxable year beginning after 2020. Now, we aren't exactly sure how organizations with multiple unrelated trades or businesses in 2018 and beyond will be impacted. And remember, starting in 2018, unrelated activities are required to be siloed, meaning losses in one activity can't offset gains in another. So we are anticipating additional guidance to be issued in regards to this. One item to note here is that there are special rules, though, in elections for Section 965 transition tax inclusion years. So if your organization was impacted by that, be sure to reference the guidance issued there, which can be found on our Moss Adams website. Moving on, next, I wanted to spend some time discussing some of the CARES Act loan provisions. Now, I'm not going to go into specific detail discussing the PPP loan, which remember, and that's that first column right there. Remember, the PPP loan provides that a portion of the loan used for payroll costs can be eligible for loan forgiveness. It was very desirable. In addition, there was the EIDL loan, which doesn't have that loan forgiveness aspect, but nonetheless provides for a low interest loan. I think we've all heard lots regarding these specific loans, so I'll spare you on repeating those details again. Rather, these next 3 slides have been provided as a reference point for you all. Some recent items bubbling up in regards to these loans, however, is that while the initial round of PPP loans did dry up very fast, there is currently a second round available. Additionally, the SBA has come out and said audits will occur for loans of over $2 million. Thus, we're encouraging all organizations who receive these loans to connect with their lenders on the best way to manage the paper trail to help ensure a clean audit of the fund's usage. Another item we wanted to mention is that there have been some recent comments, actually, on whether schools with significant endowments should return these funds. This has been highlighted by some recent comments from the Treasury Secretary as well as from President Trump, but there really has been no issued guidance on this. All borrowers, however, should assess their economic need and make a certification in good faith that the current economic uncertainty makes the loans necessary to support the ongoing operations of the organization. They should take into account their business activities as well as their ability to access other sources of liquidity. There is the opportunity to actually give back these loans up until tomorrow, May 7th, without tripping up any of the certifications required or which were required to be made when initializing these sources of funding.
And Mike, I believe I just saw today that they extended it an additional week. So if anyone on the call is considering returning any PPP funds, it sounds like you've got an additional week to do that without any sort of penalty.
Good to know. As you can see, there's a lot of moving pieces. Items are coming out and being clarified day in and day out.
That is for sure.
With that, we get to our first polling question. The polling question says, my organization has applied for and received either a PPP loan or an EIDL loan. And we'll give everyone about 30, 45 seconds to go ahead and answer. I know these loans were very, very popular. We spent a lot of time chatting with clients regarding the implications of these loans, and still many items are coming out in regards to the calculation of what can be forgiven, specifically for the PPP loans. Hold tight on some of those as well. All right, and let's about 5 more seconds before we close the poll. All right, let's check the results. All right, it looks like the majority of the organizations that are represented on the call have not. Some have, though. Certainly I think a wide array of results here. Some of the larger institutions, of course, couldn't qualify for some of these loans. Some interesting results. And with that, we're going to flip it over to Tracy.
All right, terrific. I'm going to be talking about some of the payroll and excise tax provisions that were in the Families First and the CARES Act. Of course, we are getting additional guidance every day, it seems. The FAQs have been the most common way that the IRS and Treasury have been providing guidance. They're usually pretty well written and have been very helpful. So if you have additional questions on anything we're going over today, that would be a free resource for you to go and take a look at the FAQs. Up till this point, we had many more questions than answers on these excise tax and payroll tax provisions. But as of a little over a week ago, I think, we started getting more FAQs. So now it seems the tide is turning and we're getting more answers to help with calculations and forecasting. So the provisions I'm going to be talking about are kind of broken into 2 different buckets here. On the left, we have the provisions that are available for small employers only, which is generally defined to be under 500 employees, not always, but that's been the general rule. The ones on the right-hand side have no size limit, so there isn't a restriction only to small employers. So these are the provisions we've been talking with most of our higher ed clients about, but there are some institutions that are under that 500 threshold. So we'll go through both sets. We'll start out with the no size limit side, the extension of time to pay payroll taxes, which is optional, but a way to help with current cash flow, and then the employee retention credit, which is an actual reduction in your payroll taxes due. The other provisions on the left-hand side, which are available for small employers only, are the paid sick leave and associated credit. These are a required extension of benefits relating to 2 weeks of sick leave. So for those employers under 500 employees who were required to extend this benefit, they get an associated credit. Same thing for the extended FMLA and associated credit. That one is not applicable for government entities. So not everyone on the call would be able to or would be subject to these additional requirements and therefore wouldn't be eligible for the credit. But for those on the call who are, a lot of my colleges are 501c3 public public charities, not governmental entities. We've been talking about those a lot, especially for smaller institutions. So for the payment of payroll taxes, these have been extended. Again, it's optional, not required. But when you have deposits of the employer portion of Social Security taxes, which is the 6.2%, that were originally due between March 27th of 20 and the end of 20, you can defer payment of those taxes if you would like. Those amounts that you defer will be repaid over 2 years. So half would be due at the end of 2021, and the other half will be due at the end of 2022, however much you decide you're going to defer. One of the biggest things to think about is the impact on any bond requirements or debt covenants, as well as your future cash flow obligations, because this is just kind of pushing the liability down the road. So you're going to be tracking how much of your payroll taxes you are deferring, paying, so that you have that cash currently for operations, but then planning for the end of 21 and the end of 22, having to come up with that cash. So the IRS did issue some FAQs on this extension of the payment of payroll taxes. So Form 941, which is the quarterly payroll tax report that goes to the IRS, is going to be revised for the second quarter. It not only needs to be revised for this kind of push down the road, a deferral of your payroll taxes, but it also needs to be changed for the payroll tax credits we're going to be talking about here in a minute. So that revised form, I don't believe has come out yet, but should be out soon. You don't have to make any special election in order to take advantage of this deferral. I have gotten the request or the question on can we defer payments we've already made, right? Because this was effective the end of March, and there's been some payroll tax deposits made since then. I have not seen an FAQ addressing that question, but I don't see a way that you can defer payroll the taxes that you've already paid. I think this is going to be, you decide based on when your payroll taxes are due if you're going to defer that particular payment or not, and that is the amount that you'd be adding to your liability. This does interact with other provisions. A lot of the provisions in the CARES Act are trying to contemplate no double dipping. So if you're taking advantage of one provision, that you're not also taking advantage of another provision. So in the case of extending your payroll taxes, you can defer the payment of the payroll taxes up until the time that you determine whether you're entitled to the paid leave credit, which we'll talk about from Families First. That's available for small employers only, or the employee retention credit, which is available for all employers that are qualified. So you can defer now until you figure out if you're eligible for those credits. If you did apply for and receive a Paycheck Protection Program loan, the amounts that you defer under this provision you can defer under this provision until such time as your loan is forgiven. It doesn't mean that your payroll taxes become due on that date. It just means that you have to stop your deferral at that date. So the PPP loan forgiveness program takes a little bit of time. You actually have to go through the application process, be approved and funded, and then you have to provide, I believe it's 8 weeks worth of records to show that you qualify for the loan forgiveness. At the point in time you get the loan forgiveness, that's when your eligibility to defer would end. And then any amounts that you have deferred up to that point would not be due till the end of 21 and the end of 22. So with that, we have our second poll question. As a reminder, this is required to answer in order to be able to get CPE credit. So has your organization chosen to defer payment of the employer portion of Social Security taxes to be paid later at the end of 21 or 22? So if your institution has made the decision you are going to defer, or you decided you are not going to defer, or you're not sure, those would be your optional answers. I find from talking with a lot of clients, most of my schools aren't feeling the cash crunch yet. So they're kind of two minds. One is it's free money, right? Because it's not due till the end of 21 and 22. So why not take advantage of free money? That's one camp. The other camp is our cash flow is just fine right now. We're able to meet our obligations. We don't really need the deferral, so let's just keep status quo and reassess every time we have to send in a payment for payroll taxes. So I'm thinking that's enough time for the poll. If you haven't answered yet, please do that in order to get credit. And I'm going to go ahead and close the poll. Maybe. I'm clicking submit and it's not working. There we go. So it looks like the majority of the people on the call are not going to defer or have not yet deferred. A portion of them have, and we've got about a third that's not sure, which is totally fine. We'll move on to the next. All right, we're on to credit. So the last one was just kind of pushing the liability down the road. This one is actually going to result in savings to the institution. And again, no size limit on this, so many of our higher ed clients are looking at this potential employee retention credit. In order to be a qualifying employer, I'll talk about those, how to be a qualifying employer in just a sec, but if you are a qualifying employer, the credit is equal to 50% of the wages paid to the employee in each of the qualifying quarters, and up to a total of $10,000 of wages eligible for all quarters. So each employee could be eligible or have the institution be eligible for a credit of up to $5,000. So it's certainly worth taking a look at to see if you are a qualifying employer, if you have any qualifying quarters, and then which employees might qualify in each of the quarter. You can offset your FICA taxes that are due, and any excess credit is refundable. There's a new Form 7200 that the IRS recently published so that you can request credit of any excess amounts above what your FICA is due. So in order to be a qualifying employer, you have to experience one of these two things. The first one is a partial or full suspension of operations due to governmental orders that limit commerce, travel, or group meetings due to COVID-19. So any governor that has closed their state and has any sort of stay-at-home order would potentially trigger this credit. Now, the qualifying organization has to have a partial or full suspension of operations. So, for instance, Moss Adams, we have offices that are closed, but we're able to work remotely and telecommute, so we wouldn't be eligible for the credit. But most of my higher ed clients are eligible because they had students who were on campus who had to be sent home. You had in-person classes that no longer can be conducted because of the governmental order. So that would generally qualify the organization for a partial suspension of operations due to the government shutdown. If you don't qualify that way, you could qualify under number 2, which is a significant decline of gross receipts, which begins in the quarter in which gross receipts are less than 50% of the gross receipts of the same prior calendar year quarter, and end when your gross receipts are at least 80% of the gross receipts of the same prior calendar year quarter. So if you looked at the second quarter of 2020 and you compared your gross receipts to the second quarter of 2019, if your gross receipts reduced by at least 50%, then you would qualify under number 2 and you would be eligible for the credit. So I'm not finding this is the case in higher ed because often we're not seeing reductions in gross receipts from tuition or fees. It's really the reduction in room and board, which often doesn't meet this 50% threshold. So either one of those are eligible, though, so you may have related organizations that want to use that second significant decline provision to be a qualified employer. Once you are a qualified employer, the credit is based on eligible wages that include regular wages paid plus health plan expenses that are allocable to the qualified wages under the employer-sponsored plan. So if you have up to 100 employees, the credit is on all eligible wages paid to all employees, regardless of whether they're able to provide services or not. I would bet almost every organization on this call would be over 100 employees, in which case the credit is based only on eligible wages paid to employees for the time the employee is not providing services due to COVID-19. So the example that I've been using is, say you have some facilities people that are normally working 40 hours a week every week. You're going to continue paying them, but they're only going to work every other week. So they'll work week 1, they'll stay home week 2, work week 3, stay home week 4, but they're getting paid as if they're working full-time. So half of their wages plus their health plan expenses would be eligible for the credit. And remember, the employee wages, qualifying wages, up to 50% of the first $10,000 of wages is your credit base, so up to $5,000 per employee. The same wages can't be used to calculate both the employee retention credit, the credit we're talking about, and the work opportunity tax credit. So if you have any employees who are eligible for WOTC and you're claiming that, you can't double dip. You also can't use the same wages for the qualified leave wages under Families First, which we'll talk about in a minute. Those qualified leave wages under Families First are only for employers under 500 employees, so not generally applicable in higher ed, but there are a few institutions on this call that might apply for. So it's an either or. You got to decide which credit is better. The retention credit can't be claimed if the employer is receiving a PPP loan, that's the Paycheck Protection Program loan, that's authorized under the CARE Act. Again, that's only going to be for small employers, and we saw, I believe on the earlier slide, that most people were not applying for the PPP, so those interactions generally won't apply in this group. And there is penalty relief provided for failure to deposit. So if you think you're going to qualify for the credit and you find you really didn't, there will be penalty relief in that case. So moving on to the Families First credits, these are the payroll tax credits that are generally for small and mid-sized employers. Those organizations were required to provide paid sick leave of 2 weeks and family leave of 10 weeks under the Families First Coronavirus Response Act. So for those employers who were required to provide that additional leave, they are eligible for this credit that we're talking about. For sick leave, the credit's available to employers with less than 500 full-time and part-time employees, and that's measured as of the time of the leave. So on Monday of the week, if you have 512 employees and someone wants to go out on sick or family leave under this COVID-19 provision, you are not required to provide them with that leave, and you are not eligible for the credit because you have more than 500 employees on that date. But if you have 20 people quit during the week, and at the end of the week you have 490 employees, let's say, or under 500 employees, and someone notifies you that they need to take leave under this provision, you would be eligible for the credit, and you're required to provide them with the leave because on that date you're under 500. This is different from the loan calculations for the EIDL and the PPP. That 500 employee threshold was a 12-month calculation. This is a particular day calculation. The sick leave credit applies to wages paid for an employee who needs to take a paid leave as a result of COVID-19 from April 1st through the end of 2020. And the credit can be used against the employer's Social Security taxes up to 100% of the qualified wages paid. And any excess credits can be refunded on Form 7200. So if an employee needs to take sick leave because they have to self-isolate or they obtained a diagnosis or they needed to comply with a self-isolation recommendation with respect to COVID-19, you are required, if you have less than 500 employees, to provide sick wages at 100% of their normal pay, capped at $511 per day for an aggregate total of 10 days or up to $51.10 in wages. And that would be the amount of your credit if you paid the full cap of $511 per day. If they have to leave to care for a family member or a child whose school or place of care has been closed, it's a lower threshold. You only have to pay them at 2/3 of their normal pay rate, capped at $200 per day for 10 days, or $2,000 in wages. So the amount of the credit and the required payment for leave is different depending on if it's the employee who's sick or if they are taking family sick leave. In addition to the sick leave credit, employers can take a credit for employees who have to take leave to care for a family member or child whose school or place of care has closed. And this is an additional 10 weeks beyond the sick leave of 2 that we just talked about. So the qualified wages are paid at 2/3 of the normal rate, capped at $200 per day, up to 10 weeks of $10,000 in wages. So that would be potentially the credit that you could take. For both the sick and the FMLA, you want to have documentation of why they're eligible for taking the leave and how much the credit is going to be. FAQs just came out, I want to say maybe a week and a half ago, that talk more about the documentation process. At the front end of it, the employee needs to provide you with information on why they're eligible for the sick and the FMLA. So citing that the state of California has required that we close, or my doctor says I need to self-isolate. You need to have those types of details in an affirmative statement from the employee. And then on the employer side, you need to keep track of how much of their wages are being paid under this leave so that you can substantiate the credit, along with the Form 7200 if you file it to request a credit or a refund of the credit, and the quarterly 941s that are filed where you're actually taking the credit. That would be kind of your COVID-19 packet to support this credit. We wanted to talk a couple minutes about donor provisions. This, we might not have the right audience on the call here, but you all can get in touch with your advancement people and provide this information to them, because there are special donor provisions for this year that they'll want to be aware of in their promotion to donors. The first one being, there's been a discussion for a long time about having an above-the-line deduction available for taxpayers who don't itemize. This is the first time we've actually seen it go through, and it's $300. So this is brand new. Individuals do not need to itemize in order to get a charitable contribution deduction for up to $300 for 2020. So if you are trying to do any sort of donation drive that relates to, I've seen them for employees or for students for 139 disaster relief type payments for people who need help or assistance, that's a great way to get donors who might not otherwise give because they don't generally itemize. In this instance, they'd still get a tax benefit for it up to $300. For those donors who do itemize, they've raised the deduction, the AGI deduction limit, to 100% for cash contributions in 2020 for individuals and up to 25% of taxable income for corporations. So the previous thresholds were 60% of your AGI, and for corporations it was 10% of your AGI. So in this way, if you have donors who are very philanthropic, their corporations can take a higher amount of their taxable income and offset with charitable contributions this year. And for an individual, they could actually wipe out their entire taxable income this year only by making charitable contributions. And the contributions must be made to public charities, which all of our schools would qualify, and they cannot be made to a 509A3 supporting organization or a donor advised fund. So you want to make sure if your foundations are set up as 509A3 supporting organizations, that the money does not go to the foundation, that it goes to the school instead. And you want to make sure they are not putting it into any donor advised funds, because those won't qualify for this higher AGI threshold. But otherwise, it's a great benefit to make them aware of. This is a piece to relay to your HR department. So we have an expansion of employer student loan payments. So my higher ed clients are familiar with the $5,250 in tuition remission that you can provide to employees before it becomes a taxable benefit, right? Very common in higher ed to do that. This is kind of the flip side of it. Employers can now pay up to $5,250 of employees' education expenses tax-free. That's what we've always had, but now this extends it to the student loan repayment. So for employees that you hire who have already graduated, they already have their degrees, but they've come out with student loans, you're able to give them $5,250 in 2020 to offset their student loan payments. So this is a really helpful provision, but not one that most people are thinking about right now, because we're all still in COVID mind, trying to deal with operations and taxes and loan programs. But this is a good one to let your HR know about to see if they want to expand the benefit packages you have for your employees. So with that, we're going to come to our next polling question. So on your organization's most recently filed Form 990-T, did your organization reflect multiple unrelated trades or businesses for which it was required to silo or bucket? This is kind of a precursor to our next topic, which is the 512A6 proposed regulations that just came out. So potential answers are yes, we did have more than one silo, which means you probably had a lovely Schedule M behind your 990-T, which was very confusing for the first year. Another option is no, you didn't have multiple trades or businesses, so either you didn't file a 990-T, which is the next answer, not applicable, or you only had one trade or business reported on the front page of the 990. The final option is not sure, which is totally acceptable because you may not at all be involved with the tax of your organization. So if you can take a moment here and answer the poll so you can get your CPE Mike, when you're ready, I'll have you close the poll and introduce the siloing topic.
Perfect. Yeah, let's check the results here. All right. It looks like the majority of the people who either answered yes or no said there were multiple trades or businesses. So obviously, I think the next topic will certainly be pertinent to you guys. Of course, a few didn't have a 990T filing requirement and some weren't sure. So obviously, that poll question was a great natural transition. Next, we're going to shift gears away from COVID-related legislation, and we're going to move on to the IRC Section 512A6 proposed regulations. And these were just issued in late April, actually, so it's all very fresh and new. Again, these were aimed at providing guidance in regards to the siloing or bucketing of unrelated trades or businesses. We can still comment on these proposed regulations up until the end of June 2020, but in the meantime, we can rely on these regulations as valid law. Now, generally, the proposed regulations, it follows the approach taken in the prior guidance on Section 512A6, and that was provided in Notice 2018-67. For most unrelated business activities, separate trades or businesses would be siloed utilizing the first two digits of the NAICS code, N-A-I-C-S. I'll refer to it as NAICS, that most accurately describes the business. This is actually a little bit different than what was in Notice 2018-67, which provided that activities must be siloed based off the more detailed 6-digit code. The Treasury and the IRS have declined to adopt a de minimis threshold, but they do think that the burden is sufficiently lessened with the use of the 2-digit NAICS code. Additionally, the proposed regulations state that payments from controlled entities are aggregated by payer. Thus, if an organization received payments such as rents, royalties, or interest from a controlled organization, and that controlled organization took a tax deduction for those payments, then the payments from each controlled entity is treated as a separate, unrelated trade or business. Additionally, that is actually not included in the investment activity silo, which some thought maybe could happen as well. Moving on, the proposed regulations also clarify that UBI from qualifying partnership interests, debt finance properties, and qualifying S corporation interests can be aggregated based on activity. So you can, if you have multiple debt finance properties, you can aggregate all of those into one trade or business, which was kind of a nice, I think, surprise in the regulations, actually. I do want to kind of highlight on the qualifying partnership interest point right here, though, however. Of course, this doesn't apply to all partnership interests. You can only aggregate partnership interests, which are qualifying partnership interests. Thus, the organizations or the partnerships that you're able to aggregate, you can only aggregate into a single activity interest where the exempt organization does not significantly participate. This does not include partnerships in which the exempt organization is the general partner. Thus, if you hold partnership interests and you're a general partner in that partnership, that's required to be one separate trade or business. The proposed regulations also clarify that all partnership interests meeting one of the following tests, it's an OR test, not an AND test. You just have to meet one of the four and be aggregated. The first one is the de minimis test. And this states that the organization must have less than or equal to 2% of the profits interest and 2% of the capital interest. One changed in the proposed regulations when compared to Notice 2018-67 is that the organization is not required to aggregate ownership by disqualified persons, supporting organizations, or controlled entities when determining this de minimis threshold. So you'd just be looking at the owner or the organization's ownership in the partnership interest itself. The control test, this states that the organization has less than 20% of the capital interest held by or held in the partnership. Also, any supporting organizations or controlled entities would be combined with these as well. One change in the proposed regulations when compared to Notice 2018-67 is that in regards to the control test, aggregation with disqualified persons, most significantly your substantial contributors, can be disregarded. On the next few slides is where we're going to get into the transition rule, which also pertains to qualifying partnership interests. The transition rule states that partnerships held as of 8/28/2018 will not have to look through to see if there are multiple trades or businesses. The K1 itself is treated as one trade or business if the partnership does not meet the de minimis or control test. The partnership continues to meet the requirement of the transition rules, even as the exempt organization's percentage changes after this 8/21/2018 date. The organization is permitted to rely on the transition rule only until the first date of the EO's first taxable year, beginning after the date the proposed regulations are published final. This is that transition period as well. Additionally, the organization can either apply the transition rule or the look-through rule, but not both.
Mike, can I jump in real quick
now,
before you move on?
Yeah, absolutely, yeah.
Awesome. So one of the things that I wanted to bring up here is this investment silo was one of the biggest controversial pieces of the notice. And when the notice came out in August of 18, that's why we have the date here, this was the IRS's first volley on trying to figure out how do we deal with investment activities, right? Many organizations on this call have many partnerships where the intention is just to hold it as a passive investor, whether you're holding a 0.1% interest or whether you're holding a 30% interest. If you don't have any control, you aren't involved with management, your purpose is just to hold it for investment purposes. There were some people out there in this transition time that were saying those should be treated the same, whether you hold a 0.1% interest or whether you hold a 30% interest. And so they ignored the control rule that was in the notice, and they treated all K1s from all sources as one trade or business. This proposed reg that's come out, which you don't have to rely on, the law just says you have to have a reasonable method, but this is the IRS's attempt to give us what a reasonable method is. This proposed reg clearly states that you can't aggregate K1s where you have more than a 20% interest or you have indications of control. So this transition rule that we've got up on the slide here was kind of a grandfathering rule. When it came in, it said, all right, you have a K1 that doesn't meet the de minimis or control test. So you have more than 20% or you have indications of control, for example. We're not going to make you look through because partnerships are super complex and they haven't provided a bunch of detail on trade or business underneath. So we're going to say if you held it as of 8/21/18, we're not going to make you look through to see what's underneath, and you can treat it as one trade or business if you don't meet the de minimis or control test. So this transition rule that we have in the proposed regs continues to allow that, but if you look at the third bullet point, only until the first day of the first taxable year beginning after the date the proposed regs are issued final. So in these proposed regs, the IRS is giving us notice that we've kind of grandfathered stuff to make things easy if you have a K1 that doesn't meet the control or the de minimis test. But be warned, if you don't meet one of those two tests when final regs are issued, you very likely will have to look through, which is what the look-through test is that Mike's going to talk about next. So I just want to put everyone on alert how important this 8/21/18 date is, but that there's a fuse on this. This date will only be helpful to reduce the amount of work for a little while longer until final regs are issued. The IRS is taking comments through June 23rd on these proposed regs. So the anticipation is we're going to go pretty quick from proposed to final. Of course, pretty quick in IRS speak could be, hopefully by the end of the year. So when you're looking at your investment portfolio, if you have anything that doesn't meet the de minimis or the control test, you will need to do additional work to prepare for the end of this transition rule. All right, Mike, back to you for look-through.
Perfect, yes, and moving on to the look-through rule then, this look-through rule provides that an organization does not control a partnership in which it has a direct interest, but that directly held partnership is not a qualified partnership interest because the organization holds more than a 20% capital interest. I think it's probably easiest to highlight an example here, though, I think. The example here is that an organization, it holds a 50% capital interest in Partnership A. Partnership A then holds a 4% of the capital and profits interest of Partnership B and a 10% of the capital and profits of Partnership C. The organization can aggregate UBI from Partnership B with its other qualified partnership interests as their indirect profits and capital interest is 2%, meeting that de minimis threshold right there. It cannot aggregate UBI from Partnership C as their indirect profits and capital percentage from Partnership C is 5%. So that's in excess of that 2% de minimis test right there. Thus, it does not meet that de minimis test, so it has to be a separate trader business. And I might have mixed up those partnerships. You'll see Partnership A is the 4% capital and profits interest, and Partnership B is that 10% capital and profits interest right there. All right, and that brings us to, I think, our last polling question. And the last polling question is, my organization holds a partnership investments, which will be required to be siloed or bucketed as separate trades or businesses in accordance with the IRC Section 512A6 proposed regulations. Your options here are yes, no, not sure. Of course, we acknowledge that there are some here who aren't sure, what type of partnership investments are held by the organization. As Tracy said, we certainly have a lot of organizations with a huge investment portfolio. So really analyzing these ownership percentage as well as these multi-tiered structures will certainly be pertinent, I think, going forward, just to ensure compliance with the regulations, especially when they're final. All right. And we'll give you just a few final, maybe another 10 seconds to answer. All right, and let's check the poll results. All right, it looks like, a little more than 10% do have partnership investments which were required to be siloed. Most have not, though, and some not sure. It all depends on your investment portfolio, as we said. All right, moving on, I wanted to chat about qualifying S-Corp interests. And the rules here are very similar. Each S-Corp interest is treated as a separate, unrelated trade or business. That's the general rule. No look-through is required, though, with these S-Corp rules. If you do sell a partnership or an S-Corp trade interest, the gain or loss on the disposition is treated as the same trader business as the regular income stemming from the K-1. Here is the aggregation rules, though, for those S-Corp trader businesses. UBTI from an S-Corp interest may be aggregated with other investment activities if the exempt organization's stock ownership meets the de minimis test or the control test. So if you do fall below that 2% profits interest or that 20%, you can aggregate those into the other investment activities as well, which is nice. All right, next I wanted to move on to expense allocations. The Treasury and the IRS continue to consider the allocation issue, and they actually do intend to publish a separate notice of proposed rulemaking, which provides further guidance on this issue. Until then, the current standard is any reasonable method stands. Charitable contributions should be applied after the Sections 512B6 siloing. I know there was some confusion on whether charitable contributions should be included on each Schedule N or if it should just be after you silo all activities. So we do anticipate probably the charitable contribution line on the Form 990T to actually probably move down to after you aggregate all your trades or businesses, actually. All right.
Mike, can I add some color here?
And moving, yeah, absolutely.
Beautiful. So from the expense allocation side, the IRS has been talking for years about providing guidance on how to allocate expenses that either apply to both related activity and unrelated activity. So a field house that's used both in your educational activities as well as rented out for unrelated activities. And now for how to allocate expenses among different silos, different trades or businesses. So they've been working for years on these regulations, and then the Tax Cuts and Jobs Act comes along that further complicates things. So they have to move not only from how to allocate expenses between related and unrelated, but now how to allocate it between different trades or businesses. So I'm on the technical resource panel for the AICPA, and we meet with the IRS a couple times a year. And this has been a topic of conversation for years. I think they've been working on this for 8, 10 years, something like that. It's been quite a while. Every time we meet with them, they ask for more examples. They want more examples of what a reasonable allocation would be on a reasonable methodology for allocating expenses, or what an unreasonable allocation would be. So we keep providing additional examples that they can incorporate into proposed regulations. So we were really, well, some people were really hoping that we would finally get some guidance, since they've been talking about it for so long. But the flip side of the coin is, right now, we can use any reasonable allocation method to allocate our expenses. So as long as it's supportable and reasonable and consistent, you can do whatever you'd like. And then the agent on audit would have to come up with a different method if they didn't like your allocation method. If they do come out with proposed regulations like they've been talking about, it will lock us down more to what is a reasonable allocation. And it may be an answer that we don't like. So as a sector, we kind of go back and forth. Some people want the regulation because they like more clarity, less chance that there's going to be an adjustment on audit. Other people don't want the clarity because right now we can do whatever we'd like. So we'll see. They've been talking about this for a very long time. I have no idea how long it's going to take now that they've pulled it out of these proposed regs that we were anticipating it would be included in. They did say in the proposed regs, in the commentary, that gross to gross method is not a reasonable allocation. So if you use an example of, say you have an outdoor program on campus where you have boats or bikes that you rent to your students and faculty at one rate, and you rent to community members at another rate. That's an example of gross to gross not being a reasonable allocation, because if you use revenue to allocate your expenses between the related use and the unrelated use, you can see that you would not be comparing apples to apples because you have different rates. So they came out very clearly in the commentary to the regulation saying that is not going to be a reasonable allocation. The final bullet point is super helpful because it tells us the ordering of NOLs. This has been a question since the notice came out. Actually, since the siloing came out with the Tax Cuts and Jobs Act, on you have pre-18 NOLs that have a 20-year life, not siloed, and they were allowed at 100%. We have post-2017 NOLs that are required to be siloed. You can only use them against the activity that generated the loss, and they were subject to an 80% limitation, which has now been lifted, but they were available indefinitely. So you can see how the ordering of which NOLs you use first could matter, because your supercharged NOLs, your pre-18 NOLs, expire after 20 years, and it's possible they could expire if you had to use your siloed ones first. So the guidance came out saying that you want to maximize the use of your pre-18 NOLs first before you use your post-17 siloed NOLs. So we expect that there will probably be guidance in the instructions, probably not a change to the form is my guess, because the IRS is limited on form changes, but the instructions would indicate that you're supposed to use those pre-18 NOLs with the shelf life, the 20-year shelf life, before you use the post-17s. All right, Mike, back to you for Dynamex.
Perfect, thank you. And to wrap up the presentation, we just wanted to give just a brief update on Dynamex, which of course is the new California law, which provides a standard that presumes workers are employees instead of independent contractors. If you've been following the news, I think in the past 24 hours, there has certainly been some activity. You'll note that California actually has filed lawsuit against Uber and Lyft for their misclassification of independent or of employees as independent contractors, rather. So it continues to be something that California continues to enforce. Of course, I think Uber and Lyft's facts and circumstances are certainly different than most of the organizations on the call currently. But to provide just a brief update, in September 2019, AB 5, which is commonly referred to as Dynamex, was signed into place. And it codified and clarified the decision that said that businesses must demonstrate the worker meet all three of the following in order to be an independent contractor. A, they're free from the control and the direction of the hirer in connection with the performance of the work, both under the contract for the performance of the work and in fact. B, they perform work that's outside the usual course of the hiring entity's business. And C, they're customarily engaged in an independently established trade, occupation, or business of the same nature as that which the hiring entity performs. Of course, this law did go into effect January 1st, 2020, so it is currently valid law. In February 2020, a judge rejected a request for an injunction against the bill. That was, I think, mostly sponsored by Uber and Lyft. However, the author of the bill is looking into amendments that will exempt workers in creative and artistic fields. So still more is to be seen into how this will exactly shake out. But currently it is still valid law, so we hope that you are taking a look at your independent contractors just to ensure that they do meet those three standards mentioned on the previous slide. And with that, I think I'm going to turn it over to Pam. It sounds like maybe there might be one question that we might have time for.
Actually, I think we're all good, Mike. I think we've addressed all the questions that have been submitted in the Q&A box, which is awesome. So with that, I just wanted to say, thank you to Tracy and Mike for a great presentation today and to all of you for joining us. Just as a quick reminder, if you met all CPE certification requirements, your certificate is available to download now in the CPE progress window to the right of the slide view. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy of your CPE certificate will also be emailed to you probably within 3 weeks, just in case you have any difficulty today. So again, here's some contact information for Tracy and Mike if you have any additional questions. You can also find this in the handouts that have been provided. And finally, before you go today, feel free to visit our website for some additional resources. We have some COVID-19 resources on our website, along with links to upcoming webcasts. We hope you will join us again for future ones. Finally, here's a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete the survey, as your feedback is very important to us. And we also welcome any suggestions for topics that you'd like to hear us present. Thank you for joining us, and we hope you'll join us again next time.